welcome to Business Basics, a podcast designed to give some information about how financial markets work and various accounting practices in order to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our podcast. I am Archit Janargar, and I'm your host. Today we have a guest on our show who's here to explain what venture capital is. If you're a business owner and thinking about having your company really take off, this could be a good episode to tune into. Also, if you're a Shark Tank fan, venture capital is the very force in play behind that show's idea. So our guest today is Mr. Nuri Khanun, who's here to talk to us today about venture capital. Welcome to the show and thank you for being here. First, how about we start off with a basic definition of venture capital and what it is?
Sure. So typically venture capital is risk money. I mean, that's the simplest way to describe it. So you can get loans from banks, but banks require collateral. So when you're working on a new idea and you don't have a company as yet, so you don't have any collateral that banks can lend you money with. It's based on the risk that they're taking. So venture capital is risk capital. So that's a short definition of venture capital.
And who exactly are the people and the funders that are involved in the venture capital process?
Sure. So typically, when you have money to invest, rich people put some of their money in banks. Banks don't pay more than 1 or 2% interest. So it really doesn't give you a good return on investment. So they buy shares and in stocks, different companies, and they buy mutual funds that actually in turn invest in stocks of different companies, and you buy shares in the mutual fund. But all of these things, mutual funds, hedge funds, they don't return more than like 7, 8, 10% is maximum.
Mm-hmm.
So a lot of the rich people, as well as pension funds are people put in their money so that they can get that money back in retirement. And so the pension funds really are like a typical pension fund might be a teachers union, right? Or California State Employees Union. They all have pension funds. So they have billions of dollars just sitting in the bank. Since they need that money for paying out pensions, they don't want to take a lot of risk with those. So they keep 70 to 80% of that money in really safe investments like treasury bonds. And the other 20% they invest in, that's their risk money, right? And so venture funds, as well as really rich people. So you got to invest in venture funds, you got to be more than $1 million in assets. So these are the people that take some of their 10% of the risk money that they have and they put it in venture funds. So that's where they get all their money from.
Mm-hmm. So now, what do you think is the biggest misconception out there about venture capital?
Yeah, the biggest misconception of venture capital is really they're all money managers. So they are they want to put in $1 each in 10 companies, and if one company returns 10 times, 20 times that money, they are happy. So they're really money managers. The biggest misconception is that people think that they're there to create new technology or to encourage innovation, that kind of stuff. They do it incidentally, but that's not their main goal. Their main goal is to multiply money, but at the same time, you need somebody to invest in really risky businesses, because risky businesses create a lot of jobs. So you can see how many jobs Facebook and Google and Microsoft and Oracle, all of these companies, they raised venture money, and that's how they became really, really large companies. And so that's the secret of the US innovation as well as employment. Other countries don't have as much venture capital as the US does, and that's why you see a lot of new technologies come out of the US. It's essentially somebody is willing to invest in your risky ventures, because 90% of all venture capital funded startups fail. So that money is lost. But the other 10% do really, really well.
Mm-hmm. So, what are these venture capitalists then looking for when they select a company to invest in?
Yeah, venture capital is they want to put in $1 in 10 companies each. And if one of them returns 100%, 200%, 300% of that money, that sort of makes up for all the other lost investments, right? And so essentially they're looking for really, really fast growth. If you're starting a landscaping business, that's not a fast growth company. This month you may have 10 customers, and next month you may have 12 customers, and then the month after that 13 customers. It grows very slowly.
Mhm.
But some businesses like TikTok, for example, TikTok is growing by millions every month, right? And so that's a fast growth company. And so what happens is if you invest money in a fast growth company, then it has the potential to return 100 times, 200 times what somebody initially put in. So that's what they're looking for. They're looking for very, very fast growth. And typical businesses are not fast growth. And so they're not good candidates for venture capital.
And how, if in any way, do you see this venture capital industry being affected by COVID-19?
So whenever there is a big event affecting the economy, like the 2008 stock market crash, and before that we had a recession in 1992, the first money that pulls back from the market is venture capital. So the COVID-19 crisis is one such crisis. So immediately a lot of the pension funds and really rich investors, they stop investing in venture capital. So there's a sharp pullback, and then eventually it comes back in about 5 years time. So that's what will happen to venture capital in about a year's time, 2 years time. A lot of money will dry up with venture capital, which means that they'll not may not be investing in brand new companies. So money, it usually these kinds of crises lead to what are called venture capital winters. So they last about 4 to 5 years. Money dries up, and then eventually it comes back.
And finally, then our last question for today is a two-part question. So, if you're a business thinking about going to the next level, how do you assess whether or not you're a good fit for venture capital? And if you are, how do you go about finding a venture capital firm that is aligned with your business's mission?
Sure, absolutely. So, like I was saying, if your business is capable of fast growth, if it's a TikTok or if it's Google search or if it's growing like Facebook, millions of people sign up and use your software, then you're a good candidate for venture capital. It doesn't have to be software. It can be 10, 15 years ago, smartphones were new, and you saw Android and iOS, Samsung become really big in smartphones, Apple become really big in smartphones. So something that actually has very fast growth, right? So you need to see if your business is one such business. Are you seeing exceedingly fast growth? It doesn't have to be in money. Like everybody started using Google search when it came first. They weren't making any money. They were just taking venture capital for 5 years, 10 years, whatever. And they were spending the money and building their growth, right? They had more and more users come in and use their services. And Google started earning a bit, went from zero to $1 billion in just 1 or 2 years, right? When
Mhm.
they started charging for ads on their website, that kind of stuff. So you need to see if your business is capable of really fast growth. If it is, then you're a good candidate for venture capital. So how do you find venture capital if you're a business? 10 years ago, most of the venture capital was done out of Silicon Valley, which is San Francisco Bay Area. But now a lot of the venture capital has moved out to other cities. But still, the bulk of the venture capitalists are in San Francisco. You can actually, if you go into Google and type in list of venture capitalists, you'll see a whole bunch of lists. And then you can go to their websites and figure out, is your business the kind of business they invest in? Right? You can see what other businesses they have invested in. So you need to figure out, venture capitalists invest in different things. Some invest in software companies, some invest in new medicines or biotech, some invest in other kinds of company. They invest in engineering tools, that kind of stuff. So you need to figure out whether your business is a fit for that venture capital company, and then and then you get in contact with them, and they'll have information on their website about how to get in touch with them, what's the best way to approach them. So you follow those guidelines and you should be good.
Okay, well, Mr. Cunnan, thank you for joining us today. You've been very helpful, and I think our listeners can really take away something from today's episode about a topic that not too many people know a whole lot about. So thank you.
Oh, absolutely. It is a pleasure. Thanks.
That was Mr. Nuri Khanun joining us to discuss venture capital. If you liked that episode, please like, subscribe, and leave a review for our podcast wherever you get your podcasts from. If you want interesting business reads and articles selected by me, sign up for a newsletter, which you can find by going over to our website, businessbasics.online. We also have a blog on the website discussing financial book reviews and other basic business related tips. Check out our social media as well. We're on Instagram and Twitter with the handle at PROJBIZ Basics. I'm Archit Janarkar, and thanks for listening.